As you know, we're in a time of inflation that we haven't seen in 40 years. And so we need to make sure that clients' money lasts. And now more than ever, we need to be good advocates and good stewards of our money. At our firm, we like to run our financial projections until age 100. And give people a sense of confidence that they need to make those decisions to retire. Going into retirement can seem scary, and you want to make sure you've got all of your ducks in a row. Having a certified financial planner on your team is really important, and ideally someone who is a fiduciary, who has a legal obligation to recommend investment strategies that are really in your best interest and not theirs. So much of our job here is psychologist and sitting with clients and walking them through the best and worst scenarios and trying to help them take the emotions out of it. Fear and uncertainty will only cloud decision making. And it's one of the big reasons why individual investors don't do as well in the markets as an investor who actually has an advisor. There's this common conception that you should have a 60% of your portfolio in stocks and 40% in bonds. And that's a generality, but really when we go through the process and do planning, every client is different and they have a different end game. You want to keep 3 to 6 months of your emergency savings in an interest-bearing account. And I mean, the one silver lining of inflation is that money markets are in like the 3s and 4s right now. So if you can do that, you've got a buffer. And then what we do is we take 3 to 5 years of withdrawals from the portfolio in more stable investments. So like more short-term fixed income investments. And that way, if we hit a rough patch in the market and it lasts a few years, that retirees are pulling from bonds as opposed to stocks. And so we never want to liquidate stocks when they're down.